Welcome to TheoTrade. This is Don Kaufman, May 4th, 2020. We're just a few minutes after the cash close with the S&Ps massively unchanged on the day. The Nasdaq, however, is a little bit bid there by the tune of about 0.9%. Both the Dow and the Russell finish ever so slightly lower. But what I really want to focus on in this particular session is simply this. It's a really tight, an extraordinarily dangerous range that is persistent inside of this marketplace. And I'm going to take you into that in a bit more detail, well, right here, right now. What you're looking at on your screen, and I'm just going to highlight it here for a second, this happens to be a 30-day 1 hour of the S&P futures. Now, when I'm talking about, a tight and rather narrow range, you have to recognize, okay, first of all, what the volatility of this overall marketplace has been as of late. Okay, so back up for a second before, we just look at a chart, because this is just, all on the surface. Oh, look, it's a range. That's great. Yeah, who cares? Listen, the point of me saying that, okay, if you look at things like the volatility futures, all right, and the volatility futures, and those volatility futures 16 days out are at 35.70, and I'll just highlight this for you for a second. Those little monkeys are 35.70. Go a little further out in time, okay, they're at like 35. So for the most part, the volatility futures are still effectively flipped. You go a little further out in time, they're still flipped out there. Not by much, but the volatility futures are still absolutely inverted. Okay. Next thing on the list is, sure, you can look at 36 VIX to your blue in the face, and we'll come back to the bonds here in a second. You look at the VVIX, the volatility of the volatility index, and you recognize, like, holy, this thing is still in Never Never Land, which is 120. All of your volatility products are all bid. Now let's go to work inside of the bonds. What's going on to the bonds? Boo! They absolutely are dead. I mean, it looks like somebody just, stick a fork in them, because that is over inside of the bonds. The fact that the bonds are in such a tight range is alarming unto itself. But when you've got the properties of volatility as they are right now inside of the S&P 500, and then we couple that with the fact that the S&P 500, and again, I'm going to this 30-day 1 hour, we don't seem to be able to crack this range. It makes it, okay, really, really tempting right now for traders to continue to embark upon allocations. And they rush in, and I was talking about this on the weekend video as well, let the market evolve. But people rush in and they start to allocate, and they allocate, and then they allocate, and then they allocate, and then they allocate. And you're like, oh, we cracked the range to the upside, and they allocate, and then they allocate. And you start to look at this and you're like, wait a second. So we started into this range, let's call it down here, call it April 7th, and yada, yada, yada. But you yada, yada over the best part. It's been an entire month. We're a month, okay, into a rather volatile situation. And inside of the last month, what did you have? Anywhere from a 30 on up to almost a 45 VIX, okay? And yet we've actually been range bound. And I'm telling you, okay, don't get led down the path right now. You're like, I want to continue to allocate. When I say allocate, right now, I think you have to recognize something about allocation. It ain't going to matter here whether you're bullish or bearish. It's just not going to matter. And I know some people obviously are going to claim victory, but victory is mine. The problem with a range like this, because we just dropped back into the range and rallied back, and I mean today was massively unchanged. The problem with a range like this is when it cracks huge to the upside or huge to the downside. And right now, obviously, it's a coin toss. Of course, you see all the bad economic news, and the jobs data is coming out this Friday. Oh my, the Fed might speak some more, and Congress is coming back into session. Okay, data is just piling on. That's getting worse. And of course, you're thinking down. I think you have to look to both sides of this marketplace. Okay, right now, okay, doesn't matter who you are. You have to recognize that this is going to be a binary move, higher or lower. Binary move. It's just as bad as it sounds. It's a 50-50, people. You might not want to hear that, but that's a 50-50, and you better trade it as such. So how are you going to go after this? Okay? Or more importantly, it doesn't matter right now. If you have a bunch of bullish positions or bearish positions, I am telling you, okay, without hesitation, I have bearish positions on right now. Okay? Net, I am negative delta. And yes, I am happy with my negative delta on there, but it doesn't mean I'm not hedging off. By hedging off, what am I doing? So let's actually cruise around. Let's look at some trade ideas for this. Okay, let's actually cruise over to the spiders. And I'm going to show you one type of a hedging idea. So here I am 25 days out. I'm going to open up, let's just open up about 30 strikes in this case. Okay, I've actually purchased in this instance an iron condor, and I'll just show you. Okay, and I've got this in a bunch of different accounts here, but I've actually gone out and bought an iron condor, which effectively means, and you're like, well, why would you want to do something like buy options, Don? I'll tell you exactly why. Because I've actually taken some directional bias. You know that I've got negative delta on, but you also know what I just said. We're in this binary position where we could explode to the upside or explode to the downside. And I want to give myself, okay, some degree of hedge there, but I also don't want to overpay for it. So I go out there and I'm literally buying an iron condor. And what buying the iron condor is going to do, it's going to provide, nice upside if we come up and, yeah, this is about the 305 level. And if we cruise to the downside, I really start kicking in and making some money, about 275 on this iron. So I've literally purchased the iron condor, and that's the reasoning behind purchasing the iron condor. It's simply, hey, it's a narrow, it's a dangerous range. Okay, you want to play with fire right now, you go for it, but that ain't going to be my capital at risk. We explode to the upside, even though I have bearish positions on, and I've reiterated this time again, I have bearish positions on, but if we explode to the upside, I'm not going to be crying in my Cheerios because I'm ready. Okay, so I'm ready on one hand with the iron condor. What else am I ready with? Well, I've already closed a few of these and closed them with great degrees of profitability. But I am hunting once again for the idea of a ratio back spread inside of the IWM. The IWM, okay, exploded just a little over a week ago, backed off again, could be ripe again for another back ratio. And again, for those of you that missed the back ratio the first time around, let me just knock this down to like the last 7 days of trade. Okay. Show you some of the trade activity we've had over the last 7 days. These, okay, are several. These are several of the back ratios that I've closed. If I open up just a bit more in terms of time over here, so open up the last 14 days, you can actually see I put on a back ratio in this case for 37, 38, 38 credit, whacked that back ratio anywhere from $1.85 all the way up to 497. Okay, it's not a half bad hedge to the upside. Why do I like the idea of this hedge to the upside? It's pretty simple, okay? Once again, you know that other positions I have on, I'm negative delta. My negative delta comes from things like Intel. It comes from Microsoft. It comes from Facebook. It comes from Home Depot. I have on HYG. I'm actually short, okay, Lulu. By the way, every single one of these I have positions and more. Okay, but so I have some negative delta over here. So what do? I'm going to add the possibility of positive delta up here. But when I initially put the trade on, I'm putting the trade on for a net credit. You saw like 43 cents in net credit. So if we tank, I still keep the 43 cents. But if we explode to the upside, positive delta kicks in and offsets some, not all, but some of the negative delta in there. All I wanted to do, okay, in today's session is lay this out for you. Okay, that's what I wanted to do in the evening video, is lay it out for you. Now that I've made a nice mess, so I'm going to come in tomorrow, okay, to the live chat room, and I'm going to clarify and clean up that mess a little bit. We're even doing, okay, a class specifically on these types of what I'm calling volatility back spreads. That class is going to be this Thursday during the trading session. We're going to do a class on those back spreads exactly like I'm showing you here in IWM. Why? Well, simply put, they work. They work as hedges. Okay? But if you do go down, who cares? The hedge still collects a little bit. I mean, how often can you say that? Now, does that hedge have some risk to the upside? Yeah, but it's minimal. And if we stay in a rather tight range, I'm still going to make money on a lot of the other positions. In this marketplace, okay, you got to think more than just long or short. You got to think more, okay, than just, I think we're going up or I think we're going down, okay? You got to play this a couple of steps out there. And when you're in a tight range like this, with heavy volatility, and people say what you will, but we're still trading at 36 fix. We can call this heavy volatility today, but we're still trading at a 36 fix. You know that sooner or later, there's going to be another shoe to drop. And when it does, you got to be positioned effectively, okay? You got to be positioned correctly in terms of your allocation, or you're going to get your head lopped off. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.